Dear viewers, next time when some of you visit a liquor store, chances are you will be surprised with a Coca Cola brand sitting next to familiar names. You see, Coca Cola is launching its ready to drink alcoholic beverage in the domestic market. Already, pilot tests are on in Goa and Maharashtra. Now, this is not an entirely new arena for Coca Cola. The product is already available in global markets like Japan, China, and Philippines. If it does well, this could just be the beginning with more alcoholic products and ready-to-drinks, pre-mixed cocktails in the offing. It is too soon to say what that will mean for domestic incumbents in the alcohol industry, but I don't think it will be a negative. In fact, if you asked me what is one business that could beat cyclicality, irrespective of economic recession, inflation, growth, or slowdown, liquor or alcohol business would be at the top of my mind. Now, keeping the moral overtones aside, be it an occasion to celebrate or a distraction for negative events in life, a lot of people turn to bottle or glass of liquor. There is an official study that suggests that liquor consumption is price inelastic. India is at an inflection point in my view. Now remember the long queues in Delhi after the lockdown announcement? I have seen a lot of liquor stores and new bars coming up in my neighborhood and no one is frowning. It is now a trend for the rising middle class to have a dedicated space for bars at homes with fancy glasses and liquor bottles. More Indians, including women, are raising glasses. Favorable demographics, lifestyle changes, mass urbanization, and premiumization are some of the factors that are rolling the liquor industry. The liquor segment in India is expected to grow at an 8% CAGR for next 5 years, and the growth rate for beer is estimated at 9%. If you share my view on liquor industry and are keen on riding the investment returns, researching beer, wine or liquor companies is just the starting step. Check out the list of the direct players in the slide here. But these are not the companies I'll be dwelling on today. You see, the liquor industry has its own challenges. It is highly regulated. There are quotas, controlled pricing, and rules about production, taxes, licenses, and so on. So, is there a way to ride this trend and minimize these risks? The answer lies in the supply chain, which is what we would be exploring today. Whether you're a teetotaler or a connoisseur, one thing that we all can agree on is the aesthetic appeal of glass liquor bottle. Not only aesthetic appeal, but glass also remains a preferred packaging material for alcohol as it is non-reactive unlike plastic. AGI Greenpack is one of the listed companies in this space and is the second largest glass container company in India. Glass containers make up 89% of its revenue. Of this, alcoholic beverage segment comprises 75%. The company has over 500 institutional clients across industries, such as Kingfisher, Bagpiper, Johnnie Walker, Corona, Carlsberg, Sula, Bacardi, and so on. It also supplies to Glenmark, HUL, and Coca Cola, amongst others, in the non-alcohol segment. AGI claims to have the best industry margins in the glass container industry with an EBITDA of 23%. The company has ventured into the cosmetic and perfumery segment, where the margins are likely to be better with premiumization. AGI claims to be the only container glass company in India with the flexibility to use multi-fuel option that helps when the prices of fuels are volatile. And its glass operation has one of the best production efficiencies in the industry, resulting in over 90% machine efficiency. The key raw material is soda ash. Now, AGI expects growth and premiumization in the liquor market as some of the key growth drivers. Apart from income from packaging, it also earns annual lease rental income from investment property of rupees 21 crores. For this year, that is FY24, the management has guided for a growth of 15 to 18%. The company aims to maintain the margins in the range of 21 to 23%. Now, here is an interesting development to take note of. AGI has plans to acquire H&G or Hindustan National Glass, a listed entity in the same industry. In 2 to 3 years of acquisition, based on H&G's operating efficiency, AGI expects the top line at over rupees 55 billion versus a revenue of 27 billion in FY23. However, this is subject to regulatory approvals. While the acquisition, if it goes through, will be good for growth in market share, there are a few things to keep in mind. First, acquisition will be funded by debt and is likely to take the debt to equity ratio of the company at above 1 time. Second, the operating efficiency of H&G is much lower than the company, with just 9% EBITDA margin on a trailing 12 months basis versus 23% for AGL. So, there could be some moderation in margins until full efficiencies are achieved. With return ratios at 15% and above and the debt to equity ratio at 0.8 times, the stock of AGI trades at a PE or price to earnings of 20 times. Now, Heldin Glass is another player in the glass container segment with clients in liquor manufacturing, foods, FMCG and non-alcoholic beverage manufacturing, pharma and perfumery sector. About 70% of its sales come from liquor sector with clients like United Spirits, Tilaknagar Industries and Shiva Distillery. The stock trades at a PE of 31 times. Taj Industries, a leading biotechnology player, is another key beneficiary of the rise in the beer consumption. The company has 70% share in the domestic brewery industry, catering to plants, technology, and equipment requirements of the industry. For more details on Taj, you could check out my video in the link below this one. Now, don't consider any of these names as a recommendation, but they indeed deserve to be in the extended watch list for liquor industry that goes beyond the direct players. Let me know through your likes if you found this video useful. I would also appreciate your feedback in the comments section. For more such content, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.